Renting in the United States quietly transfers your earning power to someone else every month. Homeownership redirects that same monthly effort into a personal balance sheet that grows over time. This discussion focuses on how money actually moves inside the U.S. housing system. It explains why long-term renters remain cash flow contributors, while owners become asset holders. In America, housing sits at the core of household wealth. Census data, lending structures, tax treatment, and retirement outcomes all connect back to property ownership. When someone rents, they participate in housing as an expense line. When someone owns, housing becomes a capital position. That structural difference shapes financial outcomes over decades. Rent in the U.S. follows a predictable pattern. It adjusts upward with inflation, population growth, employment concentration, and zoning limits. Large cities experience this most clearly. Housing supply grows slowly while demand expands faster. Rent reflects that imbalance. Every rent payment clears access for the current month only. The payment leaves no residual value. The next month starts at zero again. Ownership behaves differently. A monthly payment converts part of cash flow into equity. Equity accumulates quietly while the property remains usable. Over time, this creates a widening gap between renters and owners even when incomes look similar. In the American system, equity grows through structure rather than speculation. Each payment reduces the outstanding balance. Market conditions adjust property value. Inflation reduces the real burden of fixed payments. These forces operate simultaneously. Renters experience rising costs. Owners experience position growth. Equity carries functional power in the U.S. financial framework. Banks treat home equity as secured capital. That classification improves access to financing, lowers risk ratings, and expands financial options. Renters do not hold collateral, so their access remains limited to income-based evaluation. This difference affects more than borrowing. It shapes resilience. Housing costs represent one of the largest household expenses in America. When those costs remain predictable, budgeting becomes easier. Long-term planning becomes clearer. Financial stress declines. Rent lacks this predictability. Lease renewals follow market conditions rather than tenant stability. In strong labor markets, rent resets upward quickly. In constrained housing markets, options narrow. Ownership absorbs these pressures differently. Over a 10-year horizon, the difference becomes visible. Two households earn similar incomes and live in similar neighborhoods. One rents, one owns a modest primary residence. Both pay comparable monthly amounts early on. After 10 years, the renter has transferred a large sum into operating revenue. The owner has converted a significant portion of payments into equity. The renter faces current market pricing. The owner holds an appreciating asset with a declining real payment burden. This pattern explains why American homeowners consistently show higher net worth levels across income brackets. The difference does not come from discipline alone, it comes from asset participation. The timing matters. By 2026, the rental landscape has changed. Institutional ownership controls a growing share of residential units. Pricing follows yield targets and portfolio models. Tenant loyalty carries limited weight in renewal decisions. At the same time, zoning restrictions slow new construction in many metros. Supply pressure supports long-term price strength. Ownership aligns with these realities. Renting remains exposed to them. Many renters point to flexibility as a strength. In practice, flexibility carries a price. High-growth cities charge a premium for mobility. Over time, that premium compounds into a major opportunity cost. Ownership reduces that leakage. There is also a behavioral dimension. Renting creates a cycle where payments feel necessary but unproductive. Progress feels abstract. Ownership produces visible indicators. Loan balances decline. Equity statements grow. These signals reinforce disciplined financial behavior. That reinforcement matters. Maintenance costs, property taxes, and transaction fees often dominate surface-level conversations. These are manageable operational variables. Rent increases remain mandatory and recurring. Over long periods, mandatory increases outweigh variable ownership costs for stable households. Ownership also strengthens financial identity. Stable addresses reduce friction with insurance, employment, education enrollment, and financial institutions. Frequent relocation introduces hidden costs that rarely appear in spreadsheets, but consistently drain resources. This script does not promote rushed decisions. It does not assume prices move in a straight line. It does not encourage leverage beyond income capacity. It explains how the U.S. housing system rewards long-term participation. Rent pays for access. Ownership builds position. The American financial structure favors those who hold assets, rather than those who only fund them. Understanding that distinction changes outcomes. In Part 2, the focus will move deeper into how equity compounds over time, how ownership reshapes financial options, and how average earners position themselves responsibly inside this system without stretching risk. Equity works quietly. Many people underestimate it because it grows through structure rather than visible cash flow. Over long periods, that quiet growth reshapes financial position. In the U.S. housing system, equity increases through three continuous forces: balance reduction, market adjustment, and inflation impact. These forces operate every month without requiring active management. Each ownership payment reduces an outstanding obligation. That reduction converts income into retained value. Over time, the cumulative effect becomes substantial even without aggressive price movement. Market adjustment plays a parallel role. Residential property in the U.S. reflects population density, employment concentration, infrastructure investment, and land scarcity. These factors influence valuation over long horizons. Short-term fluctuations occur, yet long-term holding smooths volatility. Inflation amplifies this process. Fixed housing payments remain nominally stable while wages and prices adjust upward. As purchasing power shifts, the real cost of ownership declines relative to income. Rent adjusts in the opposite direction. This combination creates compounding without speculation. Equity also changes how households interact with the financial system. Banks classify secured assets differently from unsecured income streams. Home equity increases financial credibility. It improves access terms, approval probability, and structural flexibility. Renters remain evaluated purely on cash flow. Owners gain balance sheet weight. This distinction matters during economic stress. Job transitions, medical expenses, and market disruptions occur over long careers. Households with equity possess options. They can restructure obligations, adjust cash flow, or access liquidity under controlled conditions. Rent offers no buffer. Another overlooked factor is payment destination. Rent funds operating costs, management margins, and investor returns. Ownership payments partially recycle back into the household through equity growth. That recycling compounds across years. This explains why net worth divergence between renters and owners accelerates over time even when consumption patterns remain similar. Ownership also supports financial continuity. Long-term residence reduces transaction costs. Moving expenses, deposits, brokerage fees, and utility resets quietly drain capital. Stability preserves resources. The modern rental market intensifies this effect. Large property groups apply standardized pricing models. Renewal terms follow portfolio performance rather than tenant history. Rent increases occur automatically in strong demand zones. Ownership exits that pricing loop. Risk management remains essential. Effective ownership aligns purchase price with income stability. Conservative entry reduces exposure to market swings. Emergency reserves protect against short-term disruption. These practices support durability. Renting long-term carries its own risk profile. Renewal uncertainty, forced relocation, and market-driven cost increases introduce volatility. These pressures accumulate rather than resolve. The American financial system rewards time held over timing precision. Equity accumulation favors consistency. Holding through cycles captures structural tailwinds embedded in housing policy, lending frameworks, and urban growth patterns. By 2026, these tailwinds are already active. Supply constraints, demographic shifts, and institutional ownership have reshaped the landscape. Renting absorbs these pressures. Ownership participates in their outcomes. This perspective reframes housing from a monthly decision into a long-term positioning choice. Ownership does not guarantee wealth. It provides a mechanism. Outcomes depend on discipline, patience, and realistic expectations. Rent fulfills an immediate need. Ownership builds a durable foundation. For households planning long-term stability in the United States, equity remains one of the most powerful structural tools available. That is the equity argument.